Focus on the markets and where we are headed. Rohit Srivastava, founder and strategist of Indiacharts.com, is with us on the show now. Rohit, morning. Everyone's waiting and watching, right? If the 16,800 handle on the Nifty is going to break or no. Are you betting on lower levels, much below 16,800? What's your medium-term forecast on the Nifty now?
So I think there's one word that says it all, and that is fear is the enemy. When the markets are so fearful, that's when you should turn greedy. Easier said than done. But this is the setup that we have today, that, there's too much pessimism on the street, which is why I think the level that you're talking of, 16,800, which has worked pretty well, both as a support and resistance multiple times over the last, 12 to 13 months, is probably going to hold. That's my sense of the situation right now. We are, of course, watching it closely. Even if it did break 61% of the entire rise is at 16,600 as a worst case scenario. But right now it looks like 16,800 will hold. And if it does, then we should be looking at, one of the best rallies of this year. In fact, I think we should be at the bottom end of the market for the rest of 2023. So that's a bold statement to make. I think almost everyone I'm listening to has, even the bulls have turned very, very cautious. That is the kind of situation. People are starting to price in that there will be little or no returns or few returns in the rest of 23. I think it will be much, much different than that. So over the next month, I think we should be looking at a bounce back and retest of 17,800 from where we actually fell in the last month. That is the month of March. So that should be the first leg up. The same thing probably in Bank Nifty, we should be looking at a move going back to retest 41,600. But I think on a 12-month basis, this is a wonderful opportunity, I think, for long-term investors to really start, aggressively getting positioned in the market, because you don't get to buy such a meaningful dip in stocks every now and then with pessimism, which if measured is equal to or even greater than that seen at the end of the at the bottom of the pandemic sell-off, which is in March 2020. Some of the data readings are much more lower than that now. And so with that kind of setup, I think long-term investors have a great opportunity to get invested on a 12-month basis, not ruling out even an all-time high in the Nifty. So that is, I think, the short to medium-term setup, which I know I'm sounding far more optimistic than what the street is sounding, which is why I said that fear is the enemy and you need to take it that way.
Okay, Rohit, sounds good. I mean, we can do with an optimistic voice as well, right? And I take your point. Sometimes when you think there are absolutely no triggers and the market isn't going anywhere, buying starts emerging from absolutely nowhere. So help us sort of narrow this down further. If you're expecting the market to surprise on the upside, then which pockets look the most robust on the charts? I mean, banks have been, for instance, a huge problem. They've been the market's Achilles heel. Do you see a turnaround there?
Banks have been a problem globally, but not in India. If you actually look at it, the rally that we saw from June till now is retraced by only, 38 to 50%. Okay, so less than 50%. In fact, the Nifty has retraced more, a little more than 50%. So the Nifty is actually pulled back a lot more than banking on a broader basis. So banks in India have actually held out better than what the rest of the world is really seeing in the banking sector, where the US bank index, or the KBW index, has actually fallen to a new 52-week low in the prior months. And there's huge volume. If you look at even the stock chart of Bank of America, we see what I call a selling climax, where volumes are as high as they were at the bottom of 2009, but we are not at those lows, or 2020. So what I call this is a global banking selling climax, because you've got the events. I think most of them are discounted. I don't think this is a contagion credit crisis. I think this was the crisis, few banks going under, which can be seen as similarities to the savings and loans bank crisis seen in 1980s. So bringing it back to the sectors which you were asking, I think we stick with the best performers, which are actually capital goods, which have really held out. And of course, there are triggers, followed by defense. So those have been, I think, the better performing sectors of the last 6 months, and we go with those right on top. But follow that up with metals, which have recently been pulled down due to the growth issues. But I think that's a sector that's due to perform. If you just look at prices of the underlying, which is copper, it's almost gotten back to near the previous highs, significant uptick in copper prices. But metal stocks are not reflecting those moves simply because of the negative sentiment. So I think there's a huge gap there. Then, of course, PSU stocks, again, a performer of the last 6 months, should remain on focus. And lastly, power, which has been the theme of most of 2020, should clearly come back. So I think these are the key sectors, and we'll continue to remain focused on picking them up for the medium to longer term.
Okay, got that. Rohit, good morning. Thanks for joining us. Just going back to your point on the banks for a minute, you did say that, globally there's a problem, maybe 4 or 5 banks collapse, but it's been pretty contained to that. Do you think there's a case for the Nifty bank to rally significantly from here? And what part of it do you think will really lead it? Do you think it's the private banks, the PSU banks? And I also want your call on the IT index. Is that something that you would feel comfortable looking at right now, or you would still stay away from that?
So I'll start with the IT index. I do think there could be a worst case situation done here. The risk is really one of performance and outperformance, which is what funds want to look at, whether we should give it top allocation like we were doing in 2020 or not. So the IT index may bounce back. Even if I look at a stock like Infosys, for example, it's almost a double bottom compared to where it was in October. So it's gone back to retest those lows, but I think it could end up being a double bottom. So in that sense, the IT index does have room to start picking up again from here. But will it do as well as it did before is the only question. But it will move along with the market. Now the other point is banking sector generally does well when the economy picks up. We are of course seeing a slowdown, but you can't stay in a slowdown forever. So then should it be private banks or PSU banks? I think a bit of both. PSU banks have come into the limelight after a lot of hate. If you go back 12 months, nobody wanted to touch them. I think they continue to do well in an expanding economy because business continues to happen. So in that sense, you cannot not have banking as a whole participate on the upside. The choice between PSU and private is really individual to individual. Some people think that they don't want to take the risks with PSU banks, but I think they're not no more so dangerous as they were probably 5 years ago. So I would do a bit of both.
Can you talk a little bit more about the global markets? Can India rally and get to its all-time high levels without the support of the global markets and other macro indicators? What is your forecast or expectation on, say, the dollar index, crude, the US markets?
Yeah. I think that's a very important question. People don't always link the dots between what is happening in parts of global macro and global equity. For example, the S&P is actually closed 2 weeks positive, which gets overlooked in the short-term day-to-day gyration. So actually, it's been positive for 2 weeks. The Nasdaq has done even better. It's crossed the 20 and 40-week averages in the last couple of weeks. So you're actually seeing a lot of strength in US individual stock names. If you look at things like Tesla, you look at NVIDIA and so on, they're actually doing pretty well. So strength has returned to the US market. The fear has only been around banking, which is the only index which made a new low in the last quarter. So that's one part. Now we look at the macro. What happened to the dollar index? The dollar index peaked in September of last year after, the Bank of England basically stepped in when they had a crisis in their insurance market. And since then, the DXY has not made a new high. It's in fact fallen a lot. We did see a small rally in the DXY, a bounce back sometime last month, but it started to fall again. And after the Fed's peak, has been again weaker. So the dollar index, I think, has topped out medium to longer term. The rest of 22, I would think it will be lower and not higher. The second one is the bond market. You saw bond yields really spike in the early part of March. What people didn't notice is that spike was only in the 2-year, not in the 30-year and not in the 10-year. None of them really made new highs in bond yields. So that resulted in what we call as an intermarket divergence, classic Dow theory, which often happens before a trend reversal. And that's what we've gotten now in the bond market as well. So you have a dollar which is falling. You have the bond market which is bottomed. Rising bonds, a falling dollar, both when combined is actually a risk-on environment for global equities. And that's, I think, the situation. The near-term fears are just getting discounted. And I think the macro setup is actually positive, and which is what will actually rub off into, the rest of other markets. And the last one you mentioned is oil. The last leg down we were anticipating for oil was a test of $65 to $62. And we got that, I think, last week. We touched around 64 and bounced back from there. And I think then the worst in oil prices is probably now behind us. So we got a huge dip, almost, I think, 50% drop in oil prices if you see from top to bottom. And that impact you'll see on a lagged basis in inflation. So everybody's watching inflation data. You're going to get base effects kicking in over the next 4 months. So US inflation data will continue to fall pretty hard. And that will end up, giving you a positive cue. Even though oil prices will appear to bounce back from here because they have bottomed, what we'll hope for is that they don't go up as fast as they did last time. So therefore, the effect, is not very, very negative. The positive side of rising oil prices is going to be, stocks which are oil producers, companies like Reliance, which we were talking about earlier, may have finally hit a bottom or a low. And you could actually start seeing, Reliance has, of course, been a dog, and I'm not really giving any recommendation here because we don't give advice. But my sense is that it's reached its 40-month moving average now, which is a very long-term support. And there's a very good case for it going from being the dog to become the front runner in the market. So that's something to really watch out for.
All right, Rohit, you're sounding very positive on many sections of this market, and that voice definitely comes as a breath of fresh air. So thank you for taking out the time and speaking to us today. We hope to speak to you soon again. But with that, we do need to get into our first short break on the show. On the other side, we're going to shift focus from everything that's going on in the world of equities